All right, so now let's take a look at gross income by different income sources. So I know a lot of us are familiar with income that's earned through wages. So if we get paid a wage, it's reported on a Form W-2. However, there's other forms of income that need to be reported, both from an individual level and from a company level. The first is dividends, right? So dividends occur if you own an investment like stock or a stock, a security that decides to pay a dividend. This dividend is collected and reported in gross income in the year that it's received. So if you receive a dividend as an individual, you need to report that dividend in the year that you receive it. Same if you're a company. If a company, a corporation, receives a dividend from one of its investments, corporations can invest in other corporations as well, then that dividend is also taxed as income in the year that it's received. Which is also true on the accrual basis of accounting. So generally, dividends are taxed at the same marginal rate that is applicable to a net capital gain. So dividends are usually taxed at a lower tax rate. Generally, they're taxed at the capital gain rate, and that rate could be anywhere from 0, 15 to 20%. So depending on the individual's taxable income, the capital gain, the tax rate for that, the dividend received is 0, 15, or 20%. So that would be the tax rate on the dividend received. It's going to be determined by the individual's income. If you're a corporation and you receive a dividend from another corporation, you're actually permitted a deduction ranging from 50 to 100% of the dividend received. This is called the dividend received deduction used by corporations and only corporations. So corporations are allowed to deduct the income potentially that they receive up to 50 to 100% from dividends of stocks that they own in other companies, and then dividends that and then stocks that are not held for a long period of time. So if a dividend is paid and the stock is not held for a certain period of time, then that dividend might not qualify for the reduced rates, which is that capital gains rate of 0, 15, or 20%. So dividend is a payment received by owners of stock, owners of corporations, right? And that dividend is taxed in the year that it's received. The rate is generally less than the marginal tax rate of income, and it's based on the capital gains rate for a particular individual or corporation, and that could be 0, 15, or 20%. I'm going to skip ahead to income received from partnerships. So if you are a partner, let's say you're a partner in a business. For example, let's say you're a partner in a public auditing firm like KPMG. If you're a partner, you don't get paid a salary. Instead, you get paid from the partnership income, right? So you might so any income in that partnership will flow to you based on your partnership allocation of income. So that income is going to be reported on a Form 1065, which is the partnership income tax return, and is reported to the individuals on a Form K-1, a Form K-1. And the Form K-1 tells the IRS how much partnership income you've received in that taxable year from the partnership. This is called passive income or pass-through income, because the profits of the partnership are not taxed at the company level. Instead, that income is passed to the individuals based on their income allocation, and the individuals are going to be taxed at their normal tax rate based on the income received from the partnership return. The partnership return is a 1065, and the individuals will receive a K1, a Form K1 from that 1065, which tells the individual what to declare as income. S corporations are also similar. S corporations are entities that are mixed between a partnership and a corporation. The income is taxed to the individual. So just like the 1065 form that we talked about for partnerships in the K1, and the individuals pay the income that's allocated to them, It's a very similar method on the S corporations. You will see a question on alimony. So alimony is talked about in the homework. So before 2019, as of December 31st, 2018 and prior, if you entered into a alimony agreement, so if you entered into an alimony agreement prior to December 31st, 2018, then the income that the recipient of the alimony agreement receives would be taxable. So that would go into gross income. So if you if an individual went through a divorce and signed a separation agreement prior to December 31st, 2018, then all the years following that, the individual that receives the alimony payment would pay a tax. The person that paid the alimony payment would get a deduction, and we'll talk about itemized deductions later. However, after that date, after December 31st, 2018, so after this date, if an individual were to enter into a separation agreement and it was after December 31st, 2018, then for that, the 2019 and all the years after, that income is excluded from gross income. So if you receive an alimony payment for any agreements entered into after December 31st, 2018, then you're not eligible to be taxed on that income. However, if you entered into the agreement before December 31st, 2018, and you receive an alimony payment, that alimony is included in gross income for all the following years. And then there's another question on annuities. So what is an annuity? An annuity is an investment, a vehicle that someone pays into. So the person pays a fixed amount for the right to receive payments at a fixed rate in the future. So typically annuities, you'll see there could be like whole life insurance is a form of annuity. Pensions are a type of annuity, but basically annuity is something you can purchase an annuity, which is you put a fixed amount down to get an amount or cash flow in the future. So you put fixed amount down to get cash flow in the future. And when you put money down, generally your goal is to earn some sort of return so that your future payments are more than the money that you put into this annuity investment. The money that you put into the annuity investment, you get to exclude that from the future cash flow that you receive for the income purposes. So if you put money into an annuity, there's a calculation that you get to exclude a portion of the annuity payments in the future from the gross income, because you've actually put in capital. So you can't be taxed on your capital. Instead, this exclusion ratio and the income that you report from an annuity, the goal is to only report the return that you made, not the capital you put in. So the annuity exclusion ratio, the formula is the capital that you invested. So in this case, a taxpayer pays $10,000 for an annuity that will pay $1,000 a year, right? The expected term of the annuity is 15 years. So if you go to like an actuary table, or if you hire an actuary, they could compute that, okay, so this person, given this age, has a life expectancy of X amount of time, just like if you entered into a pension, right? And so if the person puts in 10 grand, we're going to pay them $1,000 a year and the expected life of the annuity is 15 years, right? So once you have that information, the amount that you invest, the payments that you'll receive and the number of years, you can then compute the exclusion ratio. The exclusion ratio is the investment $10,000 divided by the expected cash flow, the total expected cash flow from the annuity, which is $1,000 for 15 years. When you divide the two, you get roughly 66% or 67%. So because of that, when you receive the $1,000 a year for the next 15 years, you get to exclude $667 as income, because that fell under the annuity exclusion ratio. So when you receive the $1,000 every year, you exclude $667. When it comes to gross income, you're only going to include $333. And that's because you invested a significant portion in the cash flow that you're receiving. 667 is pretty much your principal that you're getting back, right? So you're not going to get taxed on that. You're only going to pay tax on the 333, which is your expected return on that investment. Now, what happens if the taxpayer outlives the 18 years? Well, if that happens, then in years 1 through 15, the taxpayer will exclude the 667 and only report $333 of income. However, in the years after year 15, the taxpayer will report the full amount received as income in the gross income formula. If there was a situation where the expected life of the annuity is less than 15 years, then years 1 through 10, it's the same formula. 667 is excludable, $333 is taxable. However, because the taxpayer paid more than they should have in taxes, they're allowed to deduct $4,444 because the taxpayer paid more than they should have based on their investment in this annuity. And finally, I want to talk about prizes and awards, right? So if you receive a prize or an award, you need to pay taxes on the prize or the award. And the amount is the cash received or the fair market value, right? So if you receive a prize or an award, and that prize or award is above, I believe it's $600, then you need to report that prize or award at the amount received or the fair market value. And I was wrong. The ceiling is actually $400, so I slightly wrong there. So you can exclude any amount up to $400 on a prize or an award. Anything above that you have to include. The other note on prize and award. So when it comes to gambling prizes, because you'll see a question on this, any gambling winnings are taxed, right, as a gross income. When we go on to talk about deductions later, any gambling losses you're allowed to use up to a certain amount to offset any other gambling or any other awards that you received. So gambling losses can be used to offset gambling awards. However, you can't take those gambling losses and deduct it against other income like W-2 income or dividend income. You can only deduct the gambling losses from any gambling or other prizes, awards that you received as income. So you will see a question like that. I'm going to stop here, and then there might be one more quick video in a minute. So let me stop the recording.